The term military analyst is not a legally protected term. It's not like doctor. It's more like economist. Any asshole can start calling themselves one and fart out a vaguely plausible opinion on the current situation.
Continuing on the topic of douchebags, I just did a video explaining to women why you can't find rich men, because most of the men who present themselves as rich are fake poser douchebags who borrow money and spend it on you, not the actual person who's good with his money, saves and invests it. But which brings about the philosophical question, well, do you really want a guy who's wealthy, or do you just want some schmuck to spend money on you? And I think we all know the answer to that. Continuing on the line of schmucks and douchebags. And Chad and I were talking about careers in accounting, so you might appreciate this. EBITDA. This isn't going to apply to like 95% of my audience, but just hear me out on this. So if you are a normal person who lives in the real world and you want to make a profit, everyone wants to make a profit, whether it's personal finances, like do I have more money than what I spent, than what I made? Or if you're a business, okay, our sales were this amount. This is how much money came in. What are our expenses? We subtract. Here's a profit left over. That's it. That's it. You want to know why I'm a financial genius? Because I don't make it complicated. I don't lie. I don't obfuscate. I don't make it opaque. Nope. How much money do I get? That's all that matters. I don't do price to sales. I don't do price to assets. How much money goes into my pocket? That's the only thing that matters. And for those of you out there in the real world, like let's say you just like, well, I want to invest in stocks or mutual funds. I want to make a mess. It's this simple formula, and it's the only formula that matters. I invest X amount of dollars. I should expect X plus extra dollars. There's my profit. That's all that matters. Now, some really small pea-eyed people in the world of finance who really don't want you to think anymore. They don't want you to think that way. They need you to think stupidly. They need you to believe in shit that don't make sense. Also, that they can sell you stuff where you give them X, but you get X minus dollars in return. They come up with falsehoods, lies, concepts that aren't real, like white privilege, or institutional sexism, or the patriarchy. Finance dude bros do it too. On Wall Street, they just come up with different words for it. And what they come up with, this thing is called EBITDA. And what that stands for is earnings before interest, taxes, depreciation, amortization, the lawn mow cost. And I don't know if you've noticed with the LGBTQ, XYZ, the more letters in the acronym, the more bullshit it is. The longer your title, the more bullshit it is. So EBITDA is scarcely a legitimate measure when it comes to financial analysis and investing. But what it really means is, it literally what it says is, okay, in your world, sales minus all my expenses, how much money is left over? That's real. That's what you get. Douchebags decide to say, well, wait a second now. Wait a second. See, there's some expenses that are a little bit different than others. No, they ain't. Well, they're non-cash expenses. They have to be amortized. That's fine. Still look at the cash flow. And interest costs, those aren't really associated with the operations of a firm. That's financing. Why'd you break out financing of operations? Yeah, because I got a small dick. Do you still have to pay the interest expense? Yeah, but it's not about the operations. Go eat a bag of dicks. And so in order to make it seem companies were doing better, either to sell companies or to sell stocks, you saw this very commonly in the dot-coms where, you probably even saw more recently now. I haven't paid attention to the finances of these firms, but all these Silicon Valley 2.0, they're essentially the second dot-com bubble, where all these social media firms, they're like, well, they're not making profits now, but if you look at their EBITDA, they're profitable. Well, who the fuck collects EBITDA? No one collects EBITDA. The shareholders don't get EBITDA. But in order to sell shares and make it look like, it gets stock options. Oh, look at it. Let's all jerk off at CNBC. Oh, my God, bro. I'm making money, bro. Once again, because these small dick finance individuals don't want to work a real job and they make money as in general, you can make money when things go down as stock prices go up. So no one looks at the brass tacks. No one like, well, what is the profit of the firm? They looked at EBITDA because it is your earnings before you spend money on interest, taxes, depreciation, and amortization. And the line of reasoning they give you is say, well, you see, taxes, you just got to pay taxes, right? Okay, so that doesn't speak to the profitability of the firm. And interest, that's on the debts you borrow to help finance the firm. So shouldn't that be included? No, that's a financing activity. See, that's not the actual operations. Like, we're a shoe repair company. And who cares if we borrowed $1 billion to finance a $500 million firm? That's interest. That's practically not money. So we can't subtract that, right? And then my favorite, I don't know how you assholes sleep with yourselves at night. Well, you make a lot of money. That's probably why. They say, we're not going to include depreciation and amortization. We're just going to add that back. And not to bore you with details, what depreciation and amortization is, it's an accounting method that follows this thing called the matching principle, because you want to match your expenses with the revenues they help generate. You don't have to really understand it or even agree with it. It's just something accountants like to do. Like if I buy a truck for a delivery service, that truck is going to help generate revenues over the course of 10 years, let's just say. So in order to match the true expenses of the truck, I don't write off the entire expense of the truck in the first year because it's going to help generate revenue over the next 10. So I only take 10% of the truck expense each for the next 10 years. And that will add up to the total 100% of the cost of the truck, but spread across 10 years to more accurately match with the revenues that help generate, right? So if you want to understand it from a kind of, if you want to smooth out your numbers a little bit and say, okay, what are we really making on average each year as the owner of the firm or a shareholder in the firm, you might want to know that theoretical philosophical profit. Right. But from accounting perspectives, accountants match it to kind of more give you like, okay, this is really what we're kind of making on a continual normalized basis. Doesn't fucking change the fact you spent all the money in the first year to buy the truck. And amortization is on intangible assets, which is the same thing, but I'm not going to go into that. My whole point is that depreciation and amortization, these are expenses that are spread out or amortized. You might have heard that with your mortgage. They're spread out because they help generate profits for multiple years. And so you want to have a more stable kind of profit lines. Okay, this is generally really what we're making here. It doesn't change the fact that all the money went out to pay for that truck, for those computers, for the factory, for the whatever, the tools in the very first year. And then one thing I've asked, I remember having this question as a young man, like 20, 21 years old in my accounting class. I'm like, well, for super large corporations that are constantly replacing fixed assets and computers and trucks and things that you depreciate and amortize, does it even make sense to depreciate these things? Because it's one thing if you're one guy with one truck in your moving company, right? And you replace your truck every 10 years. Okay, that might make sense. But if you're General Motors or a large corporation, your what they call capital expenses, when you're buying these big expensive long-term assets that would go to help run the entire firm the entire time. Well, are you more or less replacing stuff every year in about the same amounts? So why bother depreciating this shit? Why not all expense it in the first year? And it, by the way, it comes out cash flow the same way anyway. It doesn't really matter. So my question then is, why are you even, especially for large firms? Because by the way, when you're looking at EBITDA, you're usually talking about large, publicly traded corporations. Who is not Bob in his truck, but every year, unless they're going on an acquisition binge, they're not going to have a lot of variety in their asset purchases year to year to year. And so I just like to be much more simple. And the analyst would be more simple. The analyst cares about cash flow, not what your fucking EBITDA is. And you look at it and say, okay, well, let's just back that all out. And what are the cash flows? But in either case, it doesn't matter because it's still hypocritical to add back depreciation and amortization to EBIT, earnings before interest and taxes. You add back depreciation and amortization, EBITDA. Why are you adding that back? You got to spend that money anyway. That actually is the operations of the firm. That is expenses you got to occur, whether they're amortized or expensed in the first year. And I'm sorry if I'm talking over a lot of people's heads with the accounting. I'm more fighting off the douchebags going, well, technically, take your MBA and make paper cuts on your dick with it. So there is absolutely no reason to add EBITDA back, or I'm sorry, depreciation and amortization to EBITDA. But they still do. And so now you have this completely worthless bullshit measure about the profitability of a firm. And I don't know why people are talking EBITDA all the time. I know why. Look at the EBITDA went up. Excuse me. Isn't interest rate, weren't they like historically low? And then every corporation borrowed a shit ton of money so that their capital structure was like 90% debt. So now interest rates have to be factored in. Are any of you not paying taxes? Is that not? Oh, but then it's bullshit. Oh, we just decided to add back depreciation and amortization. Yeah. All of this is to say, what are the assets, the actual tangible physical assets of the firm are generating in terms of profit before we start to complicate the or mask the productive abilities of these individual assets with things like taxes that technically are external to the profitability of the assets. Interest rates, well, that's borrowing expense that doesn't have the factory is still going to make a certain amount of cars regardless of how we financed it. And depreciation and amortization, that's like the biggest thing of bullshit I've ever seen in my life. I mean, Nebraska doesn't even have that much bullshit in its fields. And you guys come, oh, we're trying to depreciate. Why not add back contractor costs? They're not like part of the core business. Hey, you know what, bro? How about you just add back cell phone expense, your telecommunications expense? That's not really part of it, right? Hey, why don't you add back all the money you spent on whores when you went out on traveling? And add all that really you see how absurd this becomes. And so when you see EBITDA, it is usually because they don't want to tell you this company is not making money. That's all it boils down to. Oh, we're trading at 30 times EBITDA. 30 times is, and I've said this before, and let's go one step further and introduce the idea of a PE ratio. All right. PE means price to earnings. And it's what you do every day. Except you don't call it price to earnings, you just call it shopping. You compare the price of a product to what you get, right? So when you go buy a Big Mac, you know it should be somewhere, I don't know, I haven't had a Big Mac in years, $4 or $5. Is that about what it is nowadays? You say, I am comparing the price to the earnings or the value I'm going to get out of this Big Mac, right? And if all of a sudden McDonald's says, oh yeah, it's $20 for a Big Mac, you say, whoa, the price to the $20 for one Big Mac, the price to the earnings, the price to the value, fuck that. That's not worth $20. But then if you're like $1 for a Big Mac, oh, price $1 for a Big Mac, that's a great deal. Same thing with gas. You all know 50 cents a gallon would be pretty good, right? But you know $8 a gallon would be pretty bad, right? Same thing with stocks. You got to compare a price of a stock to an earnings, how much in earnings it makes. So what are you paying in stock price for $1 in earnings? That's why sometimes it's 20, sometimes it's 15. It depends on other variables. But that's what you pay. That's what you do. But when you do a price to earnings, the E, earnings, PE, the earnings means sales minus all expenses. What you get. They don't do this EBITDA bullshit. It's earnings, not earnings before interest, taxes, depreciation, my cow farts, and a railroad tie. It's actually what you get. And technically, even that's not true because you only get a dividend. You don't actually get all the earnings, but in theory, it's reinvested into your share price of the stock, and that should be represented in the equity. I'm not going to go into that. But just to let you know, when there's bullshit, and you might see this, normally you hear about EBITDA when it comes to the stock market. If you're watching the financial shows, I don't know, do they even have Squawk Box anymore? I don't know if that's a thing anymore. Like, oh, it trades at this EBITDA. I want you to ask, what's the fucking earnings? And usually there is none. And as I've said before, when you pay for a stock price, when they start quoting price to earnings, okay, the first thing that has to be there is earnings. You can't have a PE ratio unless there's earnings there, because some companies don't make money. See, and the idea of paying some money to have $1 in earnings, that makes sense because you get more than $1. You get every year, you hopefully get more than $1. Profits grow up. But when there's firms that lose money, you can't do a PE ratio because it turns negative. Price to minus, you got losses, negative earnings, which I've always said, if you're paying to buy a firm that loses money, that's like paying someone to kick you in the nuts. And the way to tell if someone's kicked you in the nuts is the asshole trying to sell that stock says, well, price to EBITDA. Or worse, this happened at the .com days, price to sales. Sales ain't fucking profit. That's like your dude, bro. You girls like the dude, bro, comes in like, yeah, dude, I closed $250 million in sales. Okay, you closed $250 million in sales. What was your commission on? You didn't make $250 million in income. That's not your money. That's the company's money. What was your commission on that $250 million? 50,000. Dude, bro, you better go lease a S7 Series Beamer, bro. And I've always had the hair on the back of my neck go up when I've seen EBITDA. I've always seen it like, what's the fucking profit? Well, we forecast being profitable in 5 years. Well, talk to me in 5 years, asshole. And whereas, again, I've said that's where you're going to run into it more in like the Wall Street Journal, financial publicly traded stocks. You may run into that like when you're looking to buy a small company. Like you want to buy a lawn mowing company. You want to buy a franchise. The banks are like, well, look at this. You know, the price to EBITDA is that. You don't give a shit about the EBITDA, especially restaurants. I bet you. Oh, right. Why can't I remember him? Oh, the Canadian. I bet we're friends. Why can't I remember his name? He specializes in buying businesses. Restaurants will say, well, the EBITDA is this, not factoring in that restaurants are 90% financed by debt and the interest rate is what's going to kill you. Your interest expense is going to be your largest expense. So when someone's trying to sell a money-losing restaurant, they'll quote EBITDA. They won't quote you the actual net income. And so I just want to point that out. Look, guys, you had a good run in finance and Wall Street. You guys had a good run, man. You're able to hoodwink the American people for about 70 years. Now that we got the internet, now that we know, like the index can beat the vast majority of investment pros. Now that you need to be bailed 3 times? Go away. Robo-advisors beat you. Get out of here. Go away. Wear your fucking suspenders and your poofy 80s hair somewhere else. It's over. But just in case there's still some of you like, ooh, I'm going to become an investor in Wall Street. Don't listen to EBITDA. If someone says EBITDA, they're a snake oil salesman. Not a guarantee, but it's a pretty good correlation. Pretty good correlation. EBITDA is asshole. Ultranaut, $5 donating to the Make Cappy rich enough to me too. Thanks. Thank you so much. I'm going to be getting myself a trust fund very soon here. All right, that's it. Link below. If you actually want to learn about investing, and I don't even mean like investing, like, dude, bro, I'm going to trade options, bro. But are you going to be happy with enough money that you could retire early? Please go get my book link below called Bachelor Pad Economics. It's not sexy shit. We're not flipping houses, bro. We're not trading securities and currencies, bro. We're just steady Eddie, boring, good financial management that'll make you richer than 95% of the douchebags on Wall Street because most of them don't have money. Bachelor Pad Economic, link below. My Truth, the King, $5. It's all EBITDA in games until interest rates go up. Awesome, man. Yes, exactly. Bro, dude, look at all my equity in this commercial property on bridge debt. Now rates going up. Exactly. The number of guys that were like literal millionaires on paper. And then it wasn't even interest rates going up. It's just they overproduced the supply of housing and then housing crashed. in 2007. All of a sudden, they were technically insolvent, not necessarily bankrupt, but insolvent. But because they borrowed everything and on arms, no less, short-term finance, and then it went up like 0.5%. Oh, the little empire couldn't be floated no more. Girls, I'll tell you this though: if a guy says EBITDA, which you're probably not going to run into many guys that say that. If they say EBITDA, dude, my company's trading at an EBITDA, and they got their hat on backwards, yeah, he'll spend money on you, but he doesn't have any money. Just pointing it out. All right, there you go. See you guys later. Toodles.